Okay, I'll go ahead and start. Everybody, I want to thank you for dialing in today, for joining us. And I'm Tom Dawson with Taylor Growth. My partner and co-founder, Josh Colton, will also be leading this presentation. And, we're excited to be here. We're currency trade leaders, and we're direct Forex managed account providers regulated by the National Futures Association. And I'll be trying to step you through some of the lessons I've learned in about 7 years of trading Forex. So, one of my things that I often tell myself is, if life hasn't made you humble yet, it will. And that is certainly true when it comes to Forex trading. So, our company's motto is your future and our integrity, because our vision for your future is quite broad and quite expansive, and the way we plan on getting there is in the details and with truth and integrity every step of the way. So that is very much what we're about. And as I step forward on the screen, here we have the NFA Risk Warning, and the first sentence is notable. The risk of loss in Forex trading can be substantial. And I think that's worth thinking about for a minute, because it's that first loss which changed me from a gambler to an investor and a trader. So I think that although it's important to have a first loss, it's also important to minimize that first loss and to delay it as long as you can by the use of demo accounts and very conservative trade sizing. So be careful and be aware that Forex is, although it is the most liquid market to trade in, it's also one of the most dangerous, because you have several different, it's legal for countries to manipulate their own currencies. Where else do you have that? Where you have active market participants that can legally manipulate the market. So keep in mind that the technology can work against you, and you can have server outages. There's a wide variety of things that can go on. The high degree of leverage that we use and we like sometimes can turn around and smack you really hard. So be aware. It's risk money that you need to risk in this market. And with that being said, I do believe that you can change it to one of your best portfolio areas, because you see wonderful range trading opportunities that exist in Forex that exceed those of other assets, in my opinion, like stocks. In stocks, they might go far down and far up, whereas in Forex you have much more controlled and measured moves. So let me just briefly introduce you to our team. I'm the lead trader right now, and my background is in IT systems and project management. I come from the Air Force Academy and an Air Force kind of rigorous background there, where we focused on science and technology. And like I said, I've been at this about 7 years now. And my partner is Josh Colton.
And I'm here on the line, Tom. I can introduce myself.
Go ahead.
I've been trading for about 5 years, and Tom and we've been working together for about 4 years. Great guy to work with. Together, we've usually, I've gone to business school. I've done mergers and acquisitions and technology and finance, and now I'm in the world of FX trading. I have done stock trading and other things in the past as well, but the focus has been purely on FX after the last 4 years. Tom.
Okay, thank you, Josh. And Craig Brown, I call him our beautiful mind, because Craig comes to us from the Navy Nuclear Engineer program. And then he went on to graduate level engineering degrees, as well as an MBA with an emphasis in quantitative analysis. And he's currently pursuing his PhD, and he's just has a wonderful wealth of experience in terms of mathematics, statistics, programming, analysis, and really problem solving in general. And he can communicate very well. So all those things are very rare in a person. And to have them all in one person and have him on our team is a real asset. And we have Beth here, Beth Church, and she helps us put out statements every month to our clients. And we also have a CPA that oversees our books so that we are in compliance. And just real quickly, I want to step into the rules. Rules, as a child, rules are frustrating. You want no rules. You want freedom. And over time, you start to realize that those rules can be your best friend, and those rules can protect you. And we found the same thing to be true in our Forex trading. And these are actual, shots from our past, with rules and without. And our trading philosophy is quite complex. You have some people that say, I strictly focus on technicals, and other people that say, I strictly trade the news, and I think ours is as complicated as you can get, while being actionable. Because you don't want to read things that you don't use. So, very simply put, we put our focus into indicators, technical indicators, and that's our strength and our background and our main focal point. But in addition to those technical indicators, we use intermarket analysis as our daily guide. So we're not quite comfortable unless we understand where the larger patterns are. And we also make use of pattern recognition to support our understanding of market direction. We're very good, and we have a proprietary way of looking at candlesticks that allows us to not only gauge direction, but to gauge how far the market's going to move in a given direction with, about a 90% plus accuracy. So we are moving now towards using a semi-automated approach to our trading. So we're using our robots, and those robots are helping us become more disciplined because we're having to take our rules and drive that down into programming and logic, and then we manually figure out when to put those robots on different currency pairs. So sometimes we pick the direction, but we always choose the pairs, and we pick the trade size, and we manipulate the programming of the robots to suit the given characteristics of each pair. And so that constant process of tweaking and selecting how to apply the robots is actually it's actually made us better traders, and it's taught us things that some of our rules that we brought to our trading we've actually abandoned because we've seen mathematically that those were not the most effective ways to trade. And we're very conservative when it comes to money management. It's not uncommon in Forex to have people tell you to use 5-to-1 or 10-to-1 leverage, but we rarely exceed 1-to-1. We are very careful of in exceeding more than 1.25% at risk on a given trade. And in the past, even the recent past, we've had a model that allowed us to add to losers according to a very carefully managed drawdown plan, and this allowed us to move down as much as 5 or 6% in simultaneous open drawdowns. But we are moving away from that as we've seen regulatory regimes have changed in allowing us, it's taken away our ability to hedge, so we've had to move away from this drawdown model. And so, we're more comfortable now cutting our losers quickly at around 70 pips. In the past, we would go 400 to 500 pips down and add, and we were able to do that because we started with very small leverage, and then after 200 to 300 pips, we'd add more when we saw a specific technical signal. And then if the drawdown increased, we would add a third time at a calculated level, and we had a cut point where we would cut the trade. So we're probably the best in the world at adding to drawdowns, but I don't recommend it if you can't hedge. So it very much depends on what country you're in. Are you allowed to hedge? And if not, you probably will find better success in cutting your losers quickly at somewhere between 50 and 70 pips would be my recommendation. All right, so very simply, we like moving averages, particularly exponential moving averages, looking at how those cross over. Because when you tune those exponential moving averages correctly, you're able to get a nice indicator showing you when the market is turned. On oscillators, we specifically like relative strength index, and stochastics are useful in a way, but we're moving away from that a bit. Another thing we like is average true range, because that provides it provides us with implied volatility, which shows us when we're getting good price action. And we have a customized ATR indicator that we've developed that helps us understand how the market volatility is changing in relation to itself. So, okay, so next I want to just mention, like I did before, we always look at dollars, because dollars, if you understand foreign currency trading, you realize that most trading is really either buying or selling the dollar. So understanding how the dollar is flowing and how money is moving around the world at various points of the month is important. So we track that. We track correlations with other indices like the gold market, the all the other equity markets out there, the commodities, and we're quite comfortable with that. And you'll see the correlations in those with those other industries changing. It actually changes. So sometimes they'll be highly correlated events, and then other times you'll see the correlations break down, and that's when things become very interesting. And from all this milieu of data, we generate daily trade sheets that show us our support and resistance levels, and shows us with more of an 80-90% confidence where the different currency pairs are going to move, which ones are going to move the farthest, so that we can take advantage of that. So, how should you balance risk and reward in Forex trading? Very simply, you need to earn more than you lose on average. And the experts out there tell you to go for 1-to-1. So, very simply, what this means is if you put your stops 40 pips below your entry on a long, then your average profit needs to exceed 40 pips. If you can get 80 pips, great. But that ratio needs to be 1-to-1 or higher in general. And that does depend on your percent win rate. So that's kind of the basic math out there. How we balance risk and reward in manual trading is a bit different. And as I mentioned, we're moving from a manual trading strategy to an automated trading strategy. So we are cognizant of that, and I want to explain both ways of managing risk and reward. General George Patton here said, take calculated risks. That's quite different from being rash. And all of this is investing and not gambling. So you very much need that strategic plan for how you're going to take risk, what size bets you want to use, how you're going to manage that, how much you're going to put at stake at each point in time. Pearls don't lie on the seashore. If you want one, you must dive for it. And this Chinese proverb explains that scary part of the trader's gut where you've placed the trade, everything looked great, and the trade is now moving away from you. Well, most of our good trades do move away from us before they come back in our favor. But we're medium-term traders, so we're not going to jump out and second-guess ourselves. We have a very carefully controlled plan, and we put that into motion. So once we have set that trade in motion, unless it hits specific points, we're not going to take other actions. We're not going to double. We're not going to doubt ourselves. So let me just go over some real key principles here. First, know yourself and your risk tolerances over the long term. Can't say that enough. Knowing yourself and your risk tolerances. How do you know that? Well, that really gets down into the third bullet. It's what allows you to sleep at night. What allows you to talk to someone that would hold you accountable and be comfortable with that. You need to understand, if you have customers, you need to know what they're comfortable with. Inform them in writing of your maximal drawdowns that you have planned. So we want to take that worst case in mind. And for some people that might be 2%. For other people it might be 5%. Others 20%. And we have wonderful traders out there that are comfortable going into 20% drawdowns. For me, it doesn't exceed 5 or 10%. So I want to take that number and divide that by the number of campaigns that I want to wage simultaneously. And So in realistic terms, that means I don't really want to go down more than 3 or 4% on a given campaign. So that means I have to structure my initial trade size, my secondary and tertiary additions to that trade size in order to never exceed that 3% on that pair. And this idea of having multiple campaigns is important too, because you never want to just stay stuck in a drawdown and not have something that you're trading to get you out of it while you're waiting on that to come back in your way, in your favor. Number 5, patience. Most of currency trading is range trading. And if you keep that medium-term perspective in mind, then you'll be healthier. You know, we have one of our trading coaches actually says, doesn't matter which way you pick, you can make money on this pair, because very much in Forex trading you're going to have a movement through the cycles, and most Forex trading, something like 97% of it, is range trading. So if you're patient and things don't get too far out of alignment, then you'll be fine. If things do get too far out of alignment and you have a hard trending move, then yeah, you need to take the loss if it's not in your direction. Number 6, high beta pairs like the Australian and the New Zealand. These guys move. They move 2 to 3 times as far as the pound will move on a given basis. And you can see it if you go back into your weekly and monthly time frames. You'll see the difference. They move further. They're called high beta pairs because they have, high beta, high risk. They move more. So you need to either reduce your trade size there or take a longer term perspective. I recommend trading them with about half the trade size you would use on the pound. Number 7, be prepared to take a loss at some point if need be, as I've said before. Number 8, self-discipline is really remembering what you want. So the rules are there because they're your rules. They're to help you remember what you want, how you want to trade, and how you want to allocate capital and be comfortable, how you want to sleep at night, knowing that you are in line and you're not going to lose your nest egg, you're not going to lose your company. You're going to commit to this plan in writing and find someone to hold you accountable. I highly recommend that. And lastly, a little quote of wisdom from Peter Drucker. What you have to do and the way you have to do it is incredibly simple. Whether you're willing to do it is indeed another matter. So now I want to step you into how we balance risk and reward in automated trading. In this first point, are you placing enough interesting, freakish, long shot, weirdo bets? Tom Peters. And this is to get you that idea. We learn from our automation. We're actually out there learning and seeing that some of the things we thought were improbable are actually quite probable and are actually quite reasonable. And as an example, we're finding that our system works better on crosses of the major pairs, like Euro-Yen, Euro-Australian, because of the large movements on those pairs. If we're willing to cut losers quick, we can have wonderful runners. The Euro-Yen moved 400 pips on Monday, and that's something we'll be able to take advantage of that we were not taking advantage of in the past. So, very simply put, automation is a numbers game. Do the math. Do it again and again and again. You're going to look at your percent win rate, your average loss, your average win. Don't ignore the calendar. You'll find that not only the calendar but the clock. A lot of people don't like to trade on Sundays and Mondays. We don't either. But we're able to do that if our system is tuned correctly. Another thing to keep in mind is you want to look at periods where you have the best volatility and the most price action. Typically that's overlap of the London markets and the U.S. markets. That's our favorite time to trade. Pick your best pairs, though. Experiment. Your system will work different than mine, and your methods will be different than mine. So try different things. On demo accounts, trade for a long time before you go live. And again, pick the best time frames for your method. Seek quality and not quantity in terms of trading. Cut losers quickly. Only losers add to losers. And like I said, we are probably the best out there at adding to losers, but we're moving away from it because of the regulatory changes and the comfort level with our customers. They're simply happier if the losses are controlled each day and they're able to wake up to a fresh screen of trades. Move stops to break even at appropriate levels. For us, that's around 30 pips, but it can be as high as 50 pips. So once your winner becomes a winner, you don't want it to turn into a loser. So once it's comfortably in the money, 30 pips or so, move your stops to break even. Next, you want to have a hard stop loss floor that defines your maximum theoretical loss. That way, if you lose your servers, you lose your connectivity, that stop loss can get you out. And you want to let your runners ride, because typically your runners aren't going to happen. They may only happen 10 or 20% of the time. But those runners, when they happen, they're going to drastically affect your overall system profitability. So how do you let that happen? Well, automatically you can do that with trailing stops or partial closures or moving average exits. There's a lot of different ways to do it. But look into those and make sure your system will allow you to take advantage of runners, because they happen. And when they do, you want to seize that. So also monitor portfolio-wide exposure. And this is, again, the idea of the number of campaigns you're going to have going on at the same time. And 99% of success is based on failure. We all know how long it took Thomas Edison to find the light bulb filament that wouldn't burn out. And so we very much have the same practice in place. And if you're going to use automated trading, you need to be extremely disciplined. Going over your back tests and your optimizations with the best data possible. We've got tools now that we're getting 99% modeling accuracy. And so it is possible to get that in your back tests, and strive for that. Use numbers and rigor to teach you how to trade better. But don't always believe your own numbers. Continue to look at them. Trust them, but verify. As Reagan said about the nuclear regime inspections, you need to continue to monitor. Understand where your standard deviation is, and if it's outside of those parameters, then take action. You may need to perform an extra forward walk analysis iteration in order to recharacterize your robots, in order to align those robots more appropriately with the market conditions. So I skipped one bullet there, forward walk analysis versus optimization. Forward walk analysis is a wonderful tool you can look up on the internet. There's tools out there that will help you do this. And it allows you to take a backward look, let's say, 3 or 4 months of data, and you optimize over that 3 or 4 month period. And then you walk forward with live data, and you see and you compare how well your optimized results did against your forward walk analysis results. And then you move, you'll see some of them did well, some of them did poorly. And then you move forward 30 days, do the same process again. And after you've done that about 12 times, you now have a great understanding for which parameters are statistically resilient. It's almost like building a house after a rainstorm. You would build one kind of a house, and then if you had a snowstorm, you'd build a different kind of a house. Forward walk analysis allows you to look at houses built all over the world at different seasons and understand that all houses need roofs. All houses have steel posts here and there. And so this tool is, if you're going to get into automation, this tool can help you. A poem is never finished. It's only abandoned. So again, as we seek improvements and we shoot for the lowest variability with a productive curve, we want to continue to work, continue to strive, continue to do the best you can for your customers and your own investment goals. And the goal always is visually it's a steep, smooth line, and pragmatically that's a risk-adjusted return or a Sharpe ratio. So my closing thoughts: truth is the adequation of the intellect to reality. That was said by Thomas Aquinas, and Pope Benedict said that. Added to that, he said, truth is the becoming one of the I in the world. It is consonance. And so very much where we are moving to with our trading is this idea of trading in the truth. And what is the truth right now? The most important line on your platform is the price line. So this truth will allow you to assimilate a lot of different data, and it'll allow you to focus in on how to trade and how to find those points at which you can have statistically resilient advantages in the Forex market. And what you're looking for is not a great system that works great some of the time. You're looking for a good system that works well all the time. And so that difference is important. And this idea of truth it'll help you be humble, because publishing your results out there in the world, like we've done the last few years, it's both liberating and humbling. And being aware of that, and being aware of how you're doing as a trader, is much more important than impressing somebody with how great you did on a specific trade. Be honest with yourself, and be honest with the price line. And that's all I want to say about that. And lastly, Sun Tzu, always the master of strategy, has said that if you know your enemies and know yourself, you will not be imperiled in 100 battles. And keep in mind that Forex trading is very much a battle and warfare. So you need to be conscious of that and what you are capable of. So, and lastly, just wanted to point out that we do treat our currency subscribers trades the exact same way we treat those of our managed account clients and those of our, my money is in there with the managed account clients, and that trades exactly like our currency subscribers. So there is no difference. And we do, as I mentioned, put professional integrity and service first. We keep our customers at the forefront of all we do. And rules and rigor are inherent in all of our methodologies. I hope you can see that. Thank you, folks.
Are we taking questions at this time?
Yeah, I think so, if we have time.
They want to type something in the chat dialog box. I think Bill Schneider with Currency wanted to say a few words as well. We have really enjoyed our relationship with Currency. They're a great company. There's a lot of opportunity. We work well together. I'm just available to answer questions here, if there's any questions.
Okay.
And I just want to emphasize that Tom talked about the automated trading, and that we look at that as a tool. We look at that as doing the busy work of trading. It is not an end-all. I've seen way too many traders go out there and buy a black box. They don't know what it does. They put it on an account. It recklessly goes off the rails. That's not what we do here at Taylor Bros. It's very disciplined. It's built from the ground up. We know what it is. We know how it works. We use it to help us with the busy work of trading, and it is not the strategy, the end-all strategy. Further, trading has its ups and downs, and when a bad month comes, you have to judge a trader by their attitude, by their conservatism, by the controls they use, by their discipline. And the month doesn't make the year, right? It's a bad month will be overcome if those other things are in play.
Okay, we've got some questions coming in, Josh. Let me answer a couple of these. One of them is, do you use time stops? We do not use time stops right now. I have seen them being successfully used in the past, and we have experimented with them, but we don't like to use time. We would prefer that what got us into a trade would get us out. So, for instance, if we're focused on moving averages and RSIs and ATRs, we want changes in those parameters to get us out, not necessarily time. Because sometimes you'll have a quite sustainable trade that moves in a nice, a nice angle, and it just gently moves up and it lasts for days. And other times, you won't. And so we don't use time stops. And the next question, what do you think about websites and forums that allow traders to follow other traders? I personally think trading is more meditative and personal. And I'm not comfortable with working with everyone, because even Josh and I can talk on both sides of the same trade all day, and knowing when to jump and how to jump is very much about your rules and your setup. And once you've seen everything come into alignment on your trade, getting your entry that you wanted, the indicators exactly the way you wanted them, then you need to set that trade and forget it until it breaks your thresholds. Are you 70 pips out? Then you're out. Are you in? Is it rolling nicely your way? Then move stops to break even. It's very much a a matter of strategically moving.
And Tom, let me just add some insight to that question. I think the second part of that question was allow traders to follow other traders, and we see that as an emerging go-to-market strategy for FX, and we also see that as kind of a middle ground between self-trading and a complete managed account, where you can rely on a professional and follow a professional. And if not, at least a very experienced trader that's proven themselves through these types of programs. And I do think it's important to do a middle intermediary that's got good technologies, good support, good teams, and this is why we chose Currency. They're a great partner in this.
Well, that's a good point, John. That's a great point, because there were other trade copy groups that we tried and left because of either regulatory reasons or we didn't like their technology, or we thought they were choosing trade leaders that weren't necessarily awesome. So which time frame? We love the H4 time frame. We're able to get good entries, and all of our indicators seem to work better in the H4 time frame. Let's see. There was another question about, yes, we use MT4 currently. MetaTrader 4, and we're thinking about moving to NinjaTrader, but we haven't made that jump yet. And there was another question about the best book for trading. And Josh, do you have any thoughts on that? I don't.
The best book for trading. Oh, it's always the most recent book I've read. People
Right.
ask when people ask what my favorite color is, or food, or book. It's really, and I tend to collect the wisdom over time. And there's a lot of good books out there, and it's hard to endorse just one book. Go read this book, and it'll change your life. Sometimes that can happen, but I think it's good being well read.
Okay, and then
yes, we do use our own custom indicators.
yeah, our indicators we take the standard ones a lot of times and we customize them and combine them with different indicators from different times. So of course I don't want to give away the secret Coke formula here, but we do have indicators, and we tune the indicators to suit the recency that we need to see out of them. Let's see. One other question was, why do we refer to it as a combative endeavor? And I think it's because as a small trader, it is a combative endeavor. We're going up against the best minds and hundreds and hundreds of well-funded, well-trained, well-systematized traders. We're going against the biggest banks in the world, the biggest countries. It's legal for country A to call country B and support their currency. So if that's legal, then that's collusion in any other market. So I think this is a combative endeavor, and I think we need to be very comfortable with that. Best book, Greg's book, Attack Currency Trend. One book we use a lot is the quarter theory. It's basically just a simple theory, really, that there's a miniature support and resistance line at every quarter. So at the zeros, the 25, 50, 75, and 100, you have miniature support and resistance levels, and we see that bearing out. So sample charts. So you want to see what we're looking at? No, I'm not comfortable showing my charts right now. Let's see. Current euro dollar. You want my thoughts on the euro dollar? Let me pull that up just a second. Okay, on the euro dollar right now, I'll start out in the daily time frame. It looks like we've got good volatility, and looks like our relative strength of the trend has been down. It's maintaining that direction. Now I'm going to go into the H4, which is my key time frame. So I'm seeing a downward cross on the different moving averages that I use. That's also confirmed with a downward candle. There's a shadow on top of that candle, so that's confirmed. You know, the stochastic is moving downwards. You know, whenever the stochastic crosses to the downside and it does that high in the range, then that's a good sign that's confirming a sell. The relative vigor index is confirming a sell. We got almost a cross there. And in the relative strength index, it's crossing below my 40 line. So yeah, I like the sell on the euro. The only thing I'm seeing on that I don't like is the volume is drying up. The volatility is drying up. It's not. I like to see steep volatility, and I'm not seeing that right now. So I think a sell is warranted on the euro dollar. Yeah.
Okay, I think we're ready to hand off to Bill.
Okay, yeah. Just one more thing. Yeah, I use ATR for implied volatility, and there's a direct correlation there between ATR changes and the volatility of the FX market. So it's not as good as you would get in stocks, but it's the best we have. And what you want to understand is the change in volatility of a given time period relative to the other time periods. So, in other words, volatility on the euro in this hour, how does that compare to the 4-hour and the 24-hour? So you're looking at the difference there. And that's where we had to build a customized indicator to get that. So yeah, I'm done.
My name is Bill Schneider. I'm the Global Institutional Sales Manager at Currency. I'd like to thank everybody today for attending today's webinar. I'd like to thank Tom and Josh at Taylor Growth for the informative presentation. To learn more about Taylor Growth and some of our other trade leaders, you can visit www.currency.com. Today, what I'd like to speak with you about briefly is a special promotion we're running. Our partner, Liquid Markets, will be sponsoring a special offering to everyone that attended today's webinar. With any investing, and today we were talking about Forex investing, I think it's important to go over the risk warning and the risks involved in trading. So over-the-counter retail foreign currency or Forex trading may involve significant risk of loss. It is not suitable for all investors, and you should make sure you understand the risks involved before trading and seek independent advice if necessary. So through our partner Liquid Markets, we are running a special promotion that we're called Double Your Profits. It is a limited time promotion, so Liquid Markets and Currency are giving you the chance to double any profits you make up to 4% of the original account size in the Currency Trade Leader Investment Program. With any promotion, there are no guarantees of profits, and you should certainly be aware that there is a risk of loss involved in well. The promotion is very easy. You would simply open and fund your new Currency Trade Leaders investment account with a minimum account deposit of $2,000 by March 8th with Liquid Markets. We'll double any profits you make starting March 11th through March 29th, 2013. To enroll and also review the terms and conditions that are involved with the promotion, you can go to www.currency.com/liquidmarketspromo.com. With any promotion or special offering, there are terms and conditions that apply, and they're detailed for you through the landing page. For more information, please contact myself. Again, my name is Bill Schneider. I am the Global Institutional Sales Manager at Currency. My email address is for you for specific terms and conditions. Please feel free and go ahead to the registration page, which again is listed for you at the top of the screen. I'd like to thank, again, everybody who attended today's webinar. I'd like to thank FX Street for putting this together. Also, again, a special thanks to Taylor Growth and their presentation, and for our partner sponsor, Liquid Markets. So again, for any additional questions, please feel free to contact me. Thank you again for joining today's webinar, and we certainly look forward to hearing from you.